Understanding the forces behind market movements is key to becoming a successful trader. One of the most critical reports that both moves and reflects the state of the economy is the non-farm payrolls. Hello, and welcome to my channel. I'm David, a financial analyst with over 29 years of experience, specializing in currencies and commodities. Today, I will explain how to read one of the most important reports that influences not only Forex, but also other markets: non-farm payrolls. Non-farm payrolls is the data that moves both markets and currencies. Usually released on the first Friday of the month together with two other major data points regarding employment: the unemployment rate and average hourly earnings. It is important to read the various industries that make up the report and evaluate them as one component. The data could be lower than expected, but if there has been an increase in employment in any industry, the data is equally positive. Here is the non-farm payrolls report released on Friday, 4 October 2024. The table always has the same structure. Therefore, it will always be identical every time. Usually you can find it on page 5 of the report, called Employment by Selected Industry, where you find the employment for each industry and, in the last entry, the government. The last two columns are the ones that you pay attention to. In this case, August 2024 and September 2024. You simply glance over the industries. It will help you not only to work with the data, but also to have an overview of the industries that are strong or those that show weakness. This visual work can be useful as it enables you to select securities of a specific industry easily. The distinction between jobs created in the private sector and those in the public sector can provide important insights. An increase in private sector employment is generally seen as more sustainable in the long term compared to growth driven by the public sector. I typically start my analysis with mining and logging, which is the hardest industry of all. The data, as you can see, is showing obvious signs of improvement, and the industry is producing new employment. This data also tells you that if you are thinking of investing in securities or options in mining, they may have a decent price increase by virtue of an improvement in employment and thus the expansion of the industry. This data becomes even more significant considering that crude oil in September reached its lowest price of the year at $65.27. However, the figure should be interpreted with caution. It could indicate several positive factors, such as resilience within the sector, with companies possibly optimizing their extraction processes and reducing operational costs, allowing them to maintain or even increase employment despite unfavorable price conditions. It might also suggest positive expectations for the sector's future, such as a potential recovery in oil prices. Alternatively, the rise in employment could be influenced by growth in other extractive activities like natural gas or increased logging activities. Below mining and logging, you find all other industries, and although the data was less than the previous month, there was no loss of employment or crisis, but only a moment of transition. Even the retail trade has seen an increase in employment of 15,600 units in September, after a decline of 8,800 units in August and 3,600 units in July. Caution should be given to the fact that this trend is seasonal. July and August, being summer months, see businesses close and fewer purchases, while in September, with the back-to-school period, purchases increase, and consequently, so does the workforce. With experience, you will realize that retail trade is the only industry that is important to track regularly. Another significant data point is transportation and warehousing, as it represents a key sector of the economy that reflects the demand for goods and the fluidity of the supply chain. An increase in transportation typically signals economic growth, with rising sales and consumption, as well as increased warehouse activity. Conversely, a decrease in transportation traffic may indicate an economic downturn, with declining sales and consumption and reduced warehouse activity. Therefore, the transportation and logistics sector is closely linked to production and consumption levels, and a detailed analysis of this data can provide valuable insights into the overall economic health and potential market trends. In this case, following the positive figure in August, the transportation sector fell by 8,600 units in September, which is undoubtedly a negative sign. Perhaps the most important data point is manufacturing. The manufacturing sector is widely regarded as a key indicator of economic health. A significant increase or decrease in employment in this sector can shape investors' perceptions of the economy's overall strength. The decline of 7,000 units in September following a drop of 27,000 units in August is certainly not a positive sign. Similar to the manufacturing sector, employment in the construction sector is an indicator of the demand for new housing and infrastructure, which in turn can reflect economic confidence. As you can see, in September there was an increase of 25,000 units, following an even more substantial rise of 31,000 units in August. This means that the construction sector is showing signs of resilience and growth, likely driven by continued investment in infrastructure and housing projects. It also suggests that there is ongoing confidence in the economy, as businesses and individuals are willing to commit to long-term construction projects, which typically require stable financial conditions and optimism about future demand. Looking at the report, on one hand, industries like mining and logging, along with construction, show signs of positive performance, highlighting stability and potential for growth. Retail trade also saw a favorable rebound in employment, though this is largely seasonal. On the other hand, the decline in transportation and warehousing, coupled with consecutive drops in manufacturing, signals potential weaknesses in key sectors tied to broader economic activity. Overall, the data reflects strength in some areas but caution in others, leaving the overall outlook somewhat uncertain. Just looking at the table gives you a complete overview of the data. Like any piece of information, you need to extract key figures to draw your conclusion. As I have shown you earlier, you can visit the U.S. Bureau of Labor Statistics website. As you open the file, read the release, especially the first 3-4 lines summarized in the employment situation headline. Total non-farm payroll employment increased by 254,000 in September, and the unemployment rate changed little at 4.1%, the U.S. Bureau of Labor Statistics reported today. Employment continued to trend up in food services and drinking places, healthcare, government, social assistance, and construction. However, my advice is to read further the establishment survey data. You should see the non-farm payrolls split up into the different industries, because in this way, you have a broader and more complete view. The release of the non-farm payrolls data can cause significant volatility in the markets, particularly in the currency market. This initial movement, often driven by investor emotions and expectations, doesn't always accurately reflect the underlying economic reality. For this reason, you should adopt a methodical approach to manage risk and capitalize on the opportunities that follow. One recommended approach is not to enter the market immediately upon the data release. Instead, wait for the initial volatility to settle before opening a position. This will allow you to avoid false moves and reduce the risk associated with the market's emotional reaction. Often, after the data is released, a whipsaw occurs, a sharp movement in one direction, followed by an equally rapid reversal, and it is preferable to wait for the market to orient itself in a clearer direction. You may have observed that, following the publication of data, the market initially reacts in one direction, only to reverse once participants have had time to fully digest the information. This is particularly true if the overall data is mixed, with some positive and some negative components. You need to be alert and ready to take advantage of these reversals, positioning yourself contrary to the initial movement. To do this, you must analyze the data in its individual components to truly understand whether it is positive or negative. There will be situations where seemingly positive data turns out to be quite the opposite, and negative data may not be as bad as it first appears. Last but not least, there are the revisions to previous non-farm payrolls data. Revisions to the employment data from previous months are a crucial element of the non-farm payrolls report and can have a significant impact on the markets. These adjustments are made because the initial data, released on the first Friday of every month, are often based on preliminary estimates. Over time, as more accurate information is gathered, previous data can be revised. These revisions can be positive or negative and represent an important indication of the direction the economy is taking. For example, if the revisions show a significantly higher number of jobs created than initially estimated. This could bolster market confidence in the strength of the economy. Conversely, a downward revision might indicate that the economy is not as strong as it first appeared, negatively influencing market expectations. It is important to pay attention not only to the new data released, but also to the revisions of previous months, as these can change the overall interpretation of the employment trend. The revisions are reported in the same non-farm payrolls report and are usually highlighted in the first few pages of the document. For direct consultation, the report is available on the U.S. Bureau of Labor Statistics (BLS) website, where you can find both the most recent data and the revisions made to previous months. In summary, revisions to previous data should never be overlooked, as they can alter market expectations and, consequently, influence currency movements and other financial instruments. In conclusion, when the non-farm payrolls data is released, the market tends to react initially in an emotional manner, influenced by the overall figure. However, it is essential to go beyond the immediate reaction and carefully analyze the individual components of the report, including specific sectors and wages, average hourly earnings. This in-depth analysis will allow you to better understand the real economic implications and anticipate possible market reversals, which often follow a more impulsive initial movement. Thank you for watching this video. I hope the information I have shared today has given you new insights to improve your approach to Forex trading. Let me know your thoughts in the comments below. If you found these insights helpful, please give the video a like, and if you don't want to miss any future content, feel free to subscribe and click the notification bell. See you in the next video.